program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the Options Insider Radio Network, and we're really excited to be diving back into the realm of volatility. We were on hiatus for too long. We're really excited to be back and mixing it up in the vol realm again. And joining me to mix it up in the land of volatility is my co-host on the old program, none other than Mr. Mark Sebastian, the head of trading over there at Swan Wealth Advisors. Mr. Sebastian, welcome back to the program, sir.
Hello. How you doing, Mark? It's a day today, isn't it?
That is one way to describe it, yes. We are, of course, recording this, listeners, on January 24th, and it is a bit of a sell-off as we're recording it here at about 1:30 Central Time. We, of course, are coming off the heels of an aggressive sell-off yesterday, about a little over 1% actually a little under 1% in the S&P. Today, mid-session here, we're down about 1.6% in the S&P. So it looks like we're getting a little bit of a near-term correction here, which makes, of course, that much more interesting to talk about volatility right now. We'll be joined a little bit later by a great guest returning to the program. He is Scott Maidel, the Senior Portfolio Manager of Equity Derivatives over there at Russell. But before we get to him, we're going to dive right on into our first segment, the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the program where we break down the week's worth of volatility action. And there's actually some action going on today as well, like we said at the top of the show. So there's a lot to break down today. As we're recording this, VIX Cash is up over 3 points, 3.32 points to 17.09. So an aggressive move. Unlike some of the sell-offs we've seen in the past where people weren't really playing along, they seemed to just be tax-oriented or things like that earlier in the year. There wasn't really that big spike to vol to really correspond to it. Today and yesterday, of course, that is certainly not the case. VIX Cash having rallied, 4 plus 5, almost 5 handles just in the last couple of days. Mr. Sebastian, what's catching your eye in today's activity?
Not much. It's kind of a slow day.
Yeah, kind of quiet.
Happening. Oh! The S&Ps are down 2%. What did this happen? No, I'm kidding. Ugly day. Really ugly day. We're seeing the VIX really get squeezed in. We're seeing kind of futures traders and different people like that really eating their own. And just generally speaking, an ugly day for vol across the board. Unless you're long it. VIX is trading over 17 now. And you've got VXX now breaking 44 for the first time in a while. You've got the RVX, which is the Russell 2000 vol index. And really, Mark, if you look at the different indexes, you got the S&P's down like 1.5%. We've got the Russell down almost 2.75%. Huge move in the Russell. They hate it. And if you look at the RVX today, it's another one having an interesting day. Let me take a look here. It's up 3.6%, back over 20 for the first time in a while. So vol is pretty much kind of explosive. The only area where they're really kind of taking stuff down is in at all, where we're really maybe there's any kind of non-vol. We're maybe not seeing as much out of the treasuries as we might expect. VXTYN is only up 0.08 points, so barely moving. The 10-year is just trading around, 5.15 vol, that 10-year vol. So pretty low. That's about the only space, the treasury market, where things aren't going crazy. And, 2 weeks ago, I think we were talking about this. The bond market really started to move last week, where it came off from kind of 3% and had a nice little rally, and nobody could really explain it. And I guess we now know why. This is a tip out to you folks again. Follow the bond market. It's way smarter than the equity markets, and they were out front of this one again.
Those creditors know what they're up to. There's a reason why they're in front of the equity guys. It's interesting. This is a weird week. You're right. It is a very weird week. It seems like ages ago that we had VIX settlement. That was only Wednesday. And if you'll recall, listeners, the Jan VIX future settled at 12.36. That seems like ancient history now. It was only a couple of days ago that we settled at those prices. Of course, that people were lamenting about it and complaining about it even on that day, that it seemed like kind of a low settlement. Of course, you're always going to get grumbling whenever there's settlement process involved, because on that same day, the VIX cash closed up above 13, I believe, on that same day. So people were grumbling. The settlement was too low. The futures went up to 13.25 at that point, so the settlement was almost a point below where the futures were. So there's a lot of grumbling about that. Now, of course, fast forward just a couple of days, and here we are, nearly 5 handles beyond that in the cash. So it just shows you how fast things can move. And again, that's why people are so interested in volatility products, because when it hits the fan, these things tend to outperform just about everything else. This also certainly makes a lot of people happy, particularly this past week. And it wasn't so much happy earlier this week, because going into that settlement, it was pretty much a record. People always are call happy in VIX anyway, but it was a record overall in terms of call open interest. Going into Wednesday's settlement, I think the number was 8.4 million contracts outstanding there on the call side going into Jan expiration. That's 9% higher than the last time they set a record, which was back in March of last year. Of course, a lot of those calls, they missed it by a couple of days. They all expired worthless. Fast forward to today, and people who've been gobbling up calls over the past couple of days, particularly yesterday on Thursday, we saw a ton of Feb call buying in VIX. 70,000 of the Feb 16s went up for about prices around 60 to 70 cents. 40,000 of the Feb 17s went up for around 65 cents or so. So people have been just piling into calls over the past couple of days, of course, on the teeth of yesterday's sell-off as well. And those people right now, I'm wagering there's some smiling faces in that side of the fence, at least. What is it, Mark? We talked about this on the last show with Russell when he couldn't make it. What is it about February that just brings out the VIX call buyers en masse? Why Feb?
Well, we've got budget meetings. We've got, heading into March. March has been a historically rough month. Feb's not always that great. And Feb catches this January period that's typically a little ugly. Everybody's rebalanced their portfolio. Now they're really looking at what they own and what they don't. And you get hedgers. It is incredible the way February is blown up. But I think it's budget stuff, and that's what's driving everything.
Yeah, this February in particular, I agree with you, but we've seen crazies piling into Feb for the last couple of years. It just seems like the month for crazies.
I know. They love Feb. It's just, that is where everybody seems to think there's a blow up. I don't know if it's because of MLK. from 7 years ago.
MLK vol. There we go.
But hey, I would point out that again, China started doing stimulus on MLK Day, and the week of MLK, we've seen the ugliest week in some time. I mean, people look at January and think, meh. It is a month where a lot of people get caught with their shorts down, and you gotta stay on top of what you're doing. And we're seeing, it's interesting. I'm watching VIX go up, 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 even as the S&Ps are stabilizing. So I would not be shocked if we're finding a floor here, because typically when the SPOOs stop dropping and vol starts rallying, that is a sign of the market buying puts and buying the market at the same time.
Yeah, this is interesting. This shows how quickly the worm can turn out here in these products, because people were loading up on calls Monday, Tuesday, and Wednesday too, and all those calls went out worthless. And then 2 days later, all the call buyers are smiling.
You have all kinds of people trading. There's been lots of people long March and May and April. So there were a lot of people looking at this long-term stuff. But it's interesting. The back end of the curve is not up very much today, guys. So one of the problems with kind of hedging in the back months is you don't get the bang for your buck. So, for instance, as I look at this, you've got VIX cash at 17, a little actually over 17 and a quarter right now. You've got the Feb future only trading 15.40. It is not moving with the cash, and the back month, so if you were hedging in May, that's the K contract, it's up 60 cents. Congratulations on owning a contract that went from 16 and a quarter to 16.85. Great work.
That's what you get when you're playing out there, and you're buying in at an inflated level to begin with, so you can't complain too much. You know what you're getting.
Yeah, now if we get a real launch up, then you've got one thing, but I think that you may be looking at, if there were a lot of people short this stuff, they did not get caught. I don't. What's the open interest right now on VIX, on the VIX Fed? Open interest is only 380,000. So, that's not crazy big. And so I think you've got a scenario where maybe not as many people got caught this time, and that's why you're not seeing Fed move as much. We're down 30 and the Fed future's up $1.20. It's severely underperforming the cash index.
Yeah, yet the crazies are still out in Feb. I'm looking here, at the options chain. There's a size open interest all the way up to the 60 handle. 30,000 open in the 60s. Granted, it could be overwriting, but probably not.
Well, let's look. I mean, they're probably starting to set up some interesting trades in these blowups. So, if we get much higher, there might be some opportunity. Like right now, with the VIX 17, the at the money option is the 15 in Feb. So take a look at this, Mark. I could buy the 15-19 1x2 call spread. Do that or the 15-19 1x2 call spread
for even money.
Even money.
Yeah.
And that's something that would be worth $2.15 if expired today.
That's a hell of a lot better than piling into the 60s.
It is a heck of a lot better than piling into the 60s. And yeah, you've got, I want to know who bought the 20 lot of the 70 calls for.
Guilty. That was me. I was feeling right? I had a few too many drinks.
It's always interesting to see what's going on. Mark, I want you to do me a favor. Do you have a trading screen open?
Yes, I do.
Let's pretend we're buying the Feb 40 calls for 10 cents. And mark that down somewhere, and then let's just...
Should we take all 9,000 off the offer?
Yeah. Let's just see where that thing is and how that thing moves. If we get another leg out, you watch. We'll be able to flip that thing for... So if the VIX is up another 3 points, I will be able to sell that Feb 40 call at a quarter.
Yeah, I don't doubt it. This call wing in VIX is just its own beast. It's crazy.
I'm not saying that that's real vol, but it has a bid and an offer. The 40 vol, so the at the money, the 15s, the vol is 80, and the 40s, the vol is 170%. That's a skew. So the curve's gotten bid. skew's gotten bid, and the S&Ps have really stopped moving, and the VIX is really, this on a day like this with the VIX up $3.50, you'd expect Feb to be up $1.70, maybe $2, and instead it's up $1.20. It's pathetic. Shows you that there were not people caught flat-footed this time, which is interesting.
No, people have been, last couple of days particularly, they've been just devouring. At least we talked about it last week on the show, too. People have just been devouring any VIX call they can get.
It's well, and the interesting thing is that's the part that really drives people nuts is that now that means their hedge isn't going to work.
Yes,
unless you actually get the price movement. You're not getting the help from vol this time. It is interesting. The interesting
you got to get the underlying itself to actually cooperate with you. Otherwise it's moot. You mentioned RVX too. A lot of the open interest expired in Jan. A lot of trading in Jan, but still there's a lot of open interest out there, including a lot of crazies. There's crazies in RVX too. Almost 10% of the open interest is open on the Feb 30 strike. Yeah,
well, we had some a couple. Looks like somebody bought someone bought the 26 calls and the 30 calls. And at the same time,
stupid. Wow.
And they paid more for the 30 calls than the 26 calls.
That's literally a stupid, and pretty much
Dom's got to be like the happiest person on the planet with that.
Don's smashing his keyboard right now. Someone put up 1,000, almost 850 of the Feb 21s last week when we were talking about them too. So they're starting to get some of the blocks in there.
There's some action going on in the small caps again. Like I said, way leading the big indexes. You got the Dow down 1.5%, NASDAQ down 1.45%, S&P down 1.6%, RUT down 2.7%. Huge move relative to the other indexes.
Well, talking about relative and implied volatility, those are great topics to discuss with our upcoming guest, Scott Maidel from Russell. So let's dive right on into it. It's time for the Volatility Viewpoint.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint segment. You know the drill by now. This is, of course, the portion of the program where we welcome on a guest from throughout the world of volatility trading and research and analysis and proceed to pick their brains for the benefits of you, the listener. And today's guest is actually a second-timer. He's been on before. It's been a while. He is Scott Maidel, the senior portfolio manager over there at Russell Investments, particularly on the equity derivative side, which puts him right squarely in our wheelhouse. Scott, welcome back to the program.
Thanks for having me back.
And listeners, if you don't remember, if you're one of our many new listeners to the show, then I recommend you go back and check out episode 81. That was Scott's last appearance. Came out back almost a year ago, February 19th of last year. Is all about capturing the volatility premium through call overwriting. We talked a lot about writing weeklies and harvesting volatility premium through that and how that compared to other forms of income generation. Pretty interesting show. If you want to dive more into the specifics of that, I encourage you, again, head on over to theoptionsinsider.com, click on the Volatility Views page, find it in iTunes, Stitcher, wherever you get this fine program. You should find the archives there. Click on that episode 81. I think you'll like it. But for Scott, for some of our new listeners, we'll just catch them up really quick. And for our longtime listeners as well, maybe you want an update on some of that research, some of that work you've been doing. Give us a quick update here on what's been going on with the call overriding portfolio since the last time we talked to you.
Right. Good question. So, interestingly enough, 2013 was historically, since the inception of the BXM, the most challenging market environment for such a strategy since its inception. But what we did find was it was advantageous and there was value added to be had in diversifying option tenors, as discussed in the previous episode, amongst weekly, bi-weekly, and monthly options, and also creating a staggered or overlapped maturity cycle, simply from a point of view of, rolling options more frequently. So, it's not necessarily just tenor selection. It's not necessarily just strike selection, but it's also prudent implementation of the strategy itself, too. So we have had favorable results relative to the index. But I will say that, again, it has been a challenging market environment for overriding as a strategy in 2013.
And are you still primarily focused on, I believe it was the 2% out of the money weekly calls that seem to be the sweet spot for the strategy?
Right. Anything around, depending on, and it depends on how systematic, I would say how systematic, rigidly systematic you'd like to be relative to any sort of active or dynamic trade signals, let's say. So, if you're looking at, positive momentum type of market environment, longer dated options in the monthly space, it tends to be around that 2 to 3% range. That seems to be ideal, both from a total return and risk-adjusted return perspective. And obviously, the shorter tenured options that you look at, that will tend to come in a bit as well. General rule of thumb is at the money to 101 for weeklies, about 101 to 102 for 2-weekers, about 102 to 103 for monthly options, especially when your benchmark is tied to something like the BXM or the BXY.
All right, so listeners, if you want to check out more about the details, the nuances of that portfolio and that strategy, again, I encourage you, check out episode 81. But of course, Scott's been working on a lot of interesting things since the last time we spoke to him. It's one of the reasons why we wanted to bring him back on, kind of check in, see what he's working on these days. And I know some of your new research, some of your new work, Scott, really dovetails very well with an ongoing theme, an ongoing discussion we've had out here on the Volatility Views show for some time. That is essentially the volatility risk premium that occurs in the marketplace. Of course, for those listeners who aren't aware, that's, of course, the essentially sometimes substantial premium that is built into the levels of implied volatility that are reflected in the marketplace versus the actual levels of historical or realized volatility that the marketplace actually exhibits. That's been a long-running theme of ours. We've debated it. We've discussed it many times. It's interesting to see that you're kind of diving into that neck of the woods as well with some of your research and some of your practice as well over there, Scott. So why don't you go ahead and give our listeners a bit of an overview of what you're working on and how it dovetails into that discussion on the volatility risk premium and the old debate of implied versus realized.
Sure. So as a firm, I will say, Russell's belief on volatility itself is our long-term preferred positioning is definitely net short, which is obviously a risk-seeking, return-seeking strategy. And we believe that systematic net short strategies can also embed perhaps positive convexity or, trading short volatility doesn't necessarily mean that you cannot do so in a hedged manner. And we believe that diversifying across multiple sources of these volatility risk premiums is indeed the ideal methodology. So to say it a little simpler, it's not just overriding, it's not just put writing, but there's a variety of other strategies that one can embed and call it a multi-strategy approach to come out with an end product, an end result that is much more favorable than one in isolation.
So let's dive into that then, because a lot of our listeners are obviously very, very keen on how to harvest that risk premium. There's a lot of different ways you can go about it. Probably the old saw ways of, the delta neutral type trading or just shorting straddles. There's a lot of different ways you can approach it. You just outlined a few yourself. You said you like to take a many and varied approach to doing that. What are some of your favorite approaches when you're out there trying to harvest that volatility risk premium?
It's a great question, and I'm going to take the point of view of I'm going to take about 1 to 2 steps back and get to that question, and I'm actually just going to throw out a few things first. So, for example, we do manage money for across our various fund complexes globally, but we also do business with corporate and public pension plans. And really, as a starting point, these conversations always start with, what are my alternative portfolio management techniques? And it's really one of 5 things. Are we de-risking a portfolio for a specific reason? Are we diversifying into other asset classes? Are we changing the drivers of return sources, which would be more of a pure volatility strategy? Are we changing the shape of the return distribution by hedging a specific portion of their equity portfolio? Or are we just reweighting the risky asset exposure based on some sort of volatility responsive asset allocation? Now, of those 5 things, diving into a little bit more on the pure volatility risk premium strategies, the next step is really to get a client to understand, what it is we're talking about as far as terminology goes, meaning talking about implied to realized volatility, talking about volatility skew, volatility term structure, and talking about the volatility of volatility itself. So our belief is, if we can come to a point to where clients can understand these 4 things in a very brief one-liner per item, we can really simply explain strategies to answer your question, such as delta hedge straddles or strangles on the S&P 500, for example. A complementary strategy to trading straddles or strangles on the S&P 500 or any other global index would be variance swaps as well. A little bit different of mechanics there. Taking to throw out a third strategy, perhaps talking about VIX futures. Obviously, if one is systematically shorting VIX futures, of which there are some indices out there provided by some index providers, to look at the long-term track record of such a strategy, that's much more related to term structure. And again, that gets back to why we would want a client to understand some of the basic terminology that portfolio managers and traders throw back and forth a little bit interchangeably. And lastly, I'll just mention VIX options, for example. A great example of using VIX options is more directly linked to a vol-of-vol type strategy. So in short, I would say that's a little bit of a summary of a very high-level framework to get to a starting point to where clients would start thinking about adopting a systematic short vol strategy in their overall portfolio.
Sounds like you do a lot of education and a lot of hand-holding before you get them to that level, educating them on things as diverse as variance swaps and, why a risk premium even exists in the marketplace. These are all very, very in-depth educational topics to tackle before they sign on and come on board to this portfolio and this way of trading.
Right. And it is a very logical next step after clients, perhaps adopt a derivative overlay to their portfolio to be used for rebalancing or equitization. If there was, I would call it the most simple examples of why clients may use derivatives, it would be for simple cash equitization or overall portfolio rebalancing. Second step is, are they adopting strategies that are much more derivative oriented? And if so, a lot of clients have done so by using put right, call overriding, and also the very general hedging type of strategies like long put spreads or put spread collars. And to take it a step further, the much more, call it complex or sophisticated strategies systematically would be what we mentioned prior.
Scott, it sounds like you're dealing with also the ideal audience for this program. So you should just refer them to the archives of Volatility Views, and once they've gone through the 95 or so episodes we have in the can, spend a good week or two listening to the show, they'll be more than qualified to become your clients.
Well, I would say you'd be surprised. We have clients across a variety of sophistication levels, and for those who are willing. It usually doesn't take too long to, call it, get up to speed, as long as one's willing to, create a framework for understanding. With a lot of these different topics, obviously it can be a very slippery slope amongst various topics, but really it's coming up with simple ways to understand terminology and a simple framework to understand what is it exactly you're doing in a portfolio and what is it you're looking to capture.
You mentioned variance swaps, Scott, and that perks my ears up whenever I hear that, because not too many of our guests dive into those markets. What's your take on what's going on out there right now? How often do you utilize variance swaps in the portfolio? When you do, I'm assuming you go OTC, because the listed realm for variance is still, I guess, shall we say, nascent. So give us your approach on the variance swaps, how you utilize them right now.
Right. So you are correct. Variance swaps are traded over the counter. So it's not available, or little liquidity, I would say, or interest amongst the listed space. But variance swaps, I would say, are very similar, but slightly from a mathematical point that we won't get into, very similar to trading delta-hedged straddles or strangles. But within a variance swap, simply what you're doing is trading with an OTC counterparty on a variety of global indices, very common amongst the S&P 500, Euro stocks, DAX, CAC, Nikkei, for example, ASX 200 in Australia. But what I would say is, typically, you could obtain very similar exposure in a listed delta hedged straddle or strangle strategy.
That's what I was going to get to next, because of all the strategies you listed, it sounds like you're still going to the primary methodology, which is, of course, the old delta hedge straddle for the most part. That sounds like that's still your primary methodology for capturing that vol risk premium?
Yes, I would say definitely that is the primary methodology. And also there's some secondary benefits, too, from using that approach, because, one, you're sticking with listed instruments, clear to the clearinghouse from a credit perspective for institutional type investors who may be concerned with credit of a bank counterparty that may be of concern. And also, if it is an individual investor or a smaller investment firm, you may be limited to using listed options and futures only anyway.
Now, one of the downsides to that approach, obviously, is because you're delta neutral, it requires a myriad of adjustments over time, and you don't find that to be perhaps a downfall to that strategy, is that it requires constant maintenance, constant upkeep?
It's a good point you bring up, but I will say that if you're not doing it yourself, somebody else is doing it for you, and they're not doing it for free, right?
That's true. There are very few free offerings on hand there in the marketplace. So, yeah, you're right. So, I mean, that's still kind of the rub there. That still is the primary go-to methodology for harvesting that premium, even though it has all those inherent flaws. You have to adjust it. You have to stay on top of it, which makes it, again, not really ideally suitable for a large section of the audience, particularly the retail audience, because it is so hard for them to make those adjustments in their accounts. They don't have the margin treatment and everything else. So it's a strategy we like to talk about a lot, but it's unfortunate that so many of our listeners can't really utilize it effectively, which, again, hey, maybe that's good for you guys. It gives them a reason to come over there to your portfolio and have you guys do it for them.
And that's a good point you bring up, and it kind of ties into a good next topic to bring up, which is basically the evolution of some of these markets and some of the strategies that are going to be coming to market, because we do believe that as post global financial crisis, there was obviously a big interest in hedging. So we've seen a lot of hedged or risk managed strategies come to market. We've seen an explosion of long volatility strategies embedded in various funds or ETFs or ETNs. And our view is that you're going to see a natural evolution to a much more probably balanced product offering to also include more short volatility strategies as well.
And that's something I wanted to get to, too, because obviously all this talk about harvesting vol risk premium and these short vol strategies, that implies that implied is going to underperform relative to realized vol. So walk us through why you're leaning that way these days and why you think implied is not the better bet of the two.
Well, what I would say, from a natural, to your question of growth in the short volatility side, what this would indeed be would be implied trading over subsequent realized volatility. So there would indeed be a positive spread. So when you're talking about any of the strategies that we discussed, whether they be some sort of VIX-based term structure strategy, which by the way are some of the largest long and short ETNs out in the market. The point is that we do believe systematically over the long term, implied will indeed exceed implied, because there's always going to be a natural desire in the marketplace for investors to hedge their portfolio, and liquidity providers facilitating that exposure should be compensated. So we do indeed believe that implied will be above realized long term on average.
No, not that implied will be above realized, because that, of course, is the historical precedent. But that you're selling so much implied and trying to capture that differential. You're looking to obviously have that spread come in. So why do you think implied will perhaps not outperform realized as aggressively in the next coming couple of quarters?
Oh, as aggressively, I see. Well, it would be a natural thing to see if there was a decent amount of institutional and retail flow amongst a variety of strategies, whether it be any of those that we discussed earlier. If there was more money flowing into compressing that premium or selling implied volatility, one would believe that spread would come down a bit. Now, could you say that you would think that would actually compress to zero? In my opinion, that would not be the case, because then effectively, arguably, you could broadly say hedging the portfolio would become fairly free.
That would be an interesting scenario if implied there was no risk premium at all. If implied and realized were trading equally, that would be something to behold. Now, of course, all this talk about, vol risk premium implied versus realized. One of the interesting things, in fact, we've had, Pat and other guys from Russell on recently talking about the new RVX product. One of the interesting things about small cap versus the traditional things we usually discuss, volatility on S&P 500, volatility on the large cap stuff, is that almost by definition, the small cap should have a higher vol risk premium than some of these large cap stocks. So by definition, does that make you even more interested in perhaps doing some of these vol harvesting type strategies in the new Russell products and on the Russell indexes, as opposed to the big S&P? And obviously, you're a Russell guy, so you're going to be favorable to Russell. But just in general, I think from a pure mathematical perspective, those products have to be appealing to you.
Yes, absolutely. Obviously, a little biased. I would say yes, indeed. There's definitely a case to be made for a higher forecasted level of premium, but I'll say it a bit more neutral as well. Using trading S&P 500 volatility relative to Russell 2000 is now possible because of the introduction of Russell 2000 futures and options. So I think for people who are involved in these markets, using VIX products, using S&P products, it's just a natural evolution to now be able to more easily take spread type plays as well.
And we talked a lot about using these products as a tool for harvesting that volatility premium. Is that pretty much your primary use case for a vol product like a VIX option or future, or indeed an RVX product? Or do you look at it perhaps as a way to augment or add a kicker to an existing strategy, like adding an RVX or VIX upside call in addition to some other downside strategy, so you have a little bit extra pop when the market underperforms? Or are you one of these guys who looks at volatility as a more direct hedge? What's your primary use case when you're looking at these products and these volatility products in particular?
Right. Great question. And I would say clients typically fall into two different camps, either exclusively hedging oriented, or they really are interested in being somewhat of a liquidity provider, to the marketplace and capturing these risk premium. So what I would say is, can you use, volatility futures and options for hedging purposes tactically? Absolutely, from a tactical perspective, or if there's a specific reason to hedge to a specific date in the future. And that's absolutely fine, but one thing I would stress there is that it needs to be tactical. If you're systematically hedging over the long term, it's going to cost. So that needs to be, it needs to be weighed, and that cost needs to be assessed, because depending on what it is you're exactly doing, that could be very, very, very expensive. And on the other side, obviously, you can try to embed long call exposure or long call spread exposure, for example, into short vol type strategies to basically define one's max loss, or just define the overall risk profile to a specific strategy, and that's a perfectly fine approach as well.
Well, Scott, we're glad we can get you on the program to kind of check in with all the different research you have cooking over there at Russell. Before you go, is there anything else you're working on, anything else that's caught your eye over there in the volatility landscape that you think would interest our listeners, something we haven't hit on yet?
Well, what I would say is I would just keep an eye. I mean, there's been a vast interest amongst the buy side and sell side community over the past year in risk premium type of strategies, of which volatility is one. So what I would say is I would foresee a natural increase in the offering of either pure volatility or alternative strategies, a collection of alternative strategies embedded in mutual funds or the ETF space looking forward. So it will be very interesting to see what's coming to market over the next 12 to 24 months.
And if listeners want to find out more about what you're working on over there, so they just go to russell.com, or where should they go to find out more about all the different projects you're working on over there?
I would say russell.com is a broad overview of all the different business lines we have within Russell. And I'm also always happy to discuss with anyone as well. I'd be happy to put my email out for anyone that would like to contact me, which is smaidel@russell.com, SMAIDEL@russell.com.
There you go, listeners. Now you can send your questions and comments directly to Scott and save us the hassle of having to forward them. But, Scott, we're really glad we can get you back on the program. We'll have to bring you back on again down the road. We can look back a little bit more at some of these portfolios and some of these strategies you're implementing, seeing how they're working out in the marketplace, as well as checking back in on the weekly harvesting stuff. That still is fascinating for a lot of our listeners, and you were one of the early guys to really get some data on that. So we like checking in back on that every now and then as well.
Sounds great. I appreciate it. Thank you.
All right, great. Thank you, Scott. All right, and that's going to do it for our Volatility Viewpoint segment. And now we're going to keep on rolling right on into our final segment, the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, and welcome to the Crystal Ball segment. This is, of course, the portion of the show where we look ahead, break out the old prognostication devices and see what we can see. You know, we've been talking a lot on this show and other shows lately about what, if anything, could possibly spur some life into this market, and it seems like the aggregate combination of weak China and some worse than expected housing numbers and some of the earnings perhaps not playing out all has combined into this massive just weight on the marketplace. And we're starting to see vol come to life. And it's really only happened, like we said, just in the last couple of days. So it's kind of interesting and makes it interesting prognostication waters as well. Mr. Sebastian, anything could happen in the next couple of days. Which way are you leaning?
Well, you know, we've got the S&P's through its 50-day moving average. It's kind of blown through. It's blown through it. You've got it broke 1,800, which the next floor down on this thing is we could test 17 3/4 or something like that for sure. And so I think that. I don't think this is an extended event, but it looks less and less like a single one-off event. So my guess is we'll probably get some bottom feeders buying in on Monday, but or there'll be some sort of resolution in the CDS, the emerging market CDS market over the weekend. But real nice move in vol. We got a shot at a 20 based on actual market movement instead of something political. So it's
nice.
Interesting. And, if I had to put my crystal ball a week out, I think the S&Ps will probably be higher and the VIX will be lower. But I think it could be an interesting ride between now and then.
Yeah, definitely some vol to come in the next couple of days. We've already seen some crazy levels of that just in the past couple of days. And you're right too. Argentina also weighing on what's going on in the marketplace. So a lot of concerns combining. But if you look into the weeds a little bit, there are some signs of life, some signs of hope. Microsoft, one of the green names on the day, kind of blowing the doors off earnings. People are saying, "Hey, the old Microsoft is back yet again." Blah blah blah. So there are some positive threads to be found within this gloom and doom we're seeing in the marketplace today. So I think with all that seen, I think I probably will lean the same way you're leaning in that. We'll probably be a wee bit off of this, but it's not going to be a crazy, probably maybe, who knows, maybe 15 handle in VIX cash come this time next week. Market having rallied a little bit, bounced off these lows. Depends. Of course, we have a big week next week from an earnings perspective. So some of these names deliver, of course, the big fruit company on Monday. We've got Google and other ones reporting Ford next week as well. Those names could set a narrative as well. If Ford and Google and Apple all kind of underperform, then guess what? VIX is heading higher. But aside from that, if they all kind of come in middling to meh, then we'll probably be, probably back bouncing and, a little bit coming off the heels here. The call buyers taking some of their love and going home in VIX maybe for a little bit. Except for my 20 lot of 70s in Feb. Those are coming to play.
Yeah, no kidding. So the other piece is the Treasury market stopped rallying. So that could be another sign that maybe we're done.
All right. Thank you, Mr. Sebastian. And that, unfortunately, is all the time we have for this episode of Volatility Views. I would also like to thank our guest, of course, Scott from Russell. If you want to learn more about what he's cooking, head on over there to russell.com. Got to click around a little bit to find all of his research. Of course, he was nice enough to give us his direct email as well. So if you have specific questions or comments about what they're working on, shoot him an email. I'll let him know you heard him on Vol Views and you have questions about his premium harvesting or about the capturing of the volatility risk premium in the marketplace or all the different portfolios that he's working on over there at Russell. Speaking of things we're working on, Mark, what's cooking in the land of Option Pit and indeed Swan Wealth Advisors?
Well, Option Pit's going to be launching kind of a little overhaul of its services. Keep an eye out for that middle of February. And we're going to revamped and rebooted and awesome new stuff. Swan, we just continue. We love these types of sell-offs. It makes people realize that, hey, you know what? Would have been great if I was hedged.
I say this proves your value added on a day like today.
It does indeed, and so we're happy campers here. If we drop another couple hundred points, that's a few $100 million on AUM for us typically. So I'm all for it.
There you go. I love it. Looking at it with the cynical, self-interested eye, which, hey, of course, we all do that. We like that here on the show as well. It gives us stuff to talk about, so we all do that.
Exactly. If I'm not self-interested, then I'm not worth listening to.
All right. And, of course, if you want to join us here on the Vol Views program, a lot of great ways to do it. Unfortunately, we didn't have time to open up the volatility voicemail for today, but keep sending in those questions. You guys are great. A lot of you guys writing in about the interesting conversation Russell and I had last week about the put right index versus the buy right index and some reasons why those two may perform as differently as they do. If you have other questions or comments, a lot of great ways to send them in to us. Of course, you can surf on over to theoptionsinsider.com. Leave them there. Leave a comment on the show notes so we can route it to the appropriate show. And, of course, you can also leave us a literal volatility voicemail, 773-669-4VOL. That's 4865. We'd love to hear your voices here on the show. Of course, you can hit us up via email, questions@theoptionsinsider.com. Just be sure to put volatility views in the subject line so we know which way to route your question. Or find us on Twitter or on Facebook, twitter.com/options, facebook.com/theoptionsinsider. A lot of great ways for you guys to get in touch with us and make your voices heard on this program. On behalf of Mark and Scott and for all of our guests in the past on Volatility Views, I want to thank all of you guys out there for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.